In today's lesson, we're going to be thinking in the tax area about gross income, inclusions, and exclusions from tax. So let's keep some general things in mind. First, individuals are cash basis taxpayers. So you may hear that sometimes businesses can be accrual basis taxpayers, and indeed if you've had an accounting class, you know that businesses are supposed to do accrual basis accounting, but as taxpayers, individuals are cash basis taxpayers. So it doesn't matter when the income's earned or when the expense is incurred, it matters when it's received or paid. So one of the gross income items is wages or salary. Another is interest income. And interest income can be either taxed or untaxed. An example of untaxed interest income would be a municipal bond. But many types of interest income, like income received from the bank, is in fact taxed. Dividends are line 9 of the tax return, and they're taxed. However, starting in 2003, they're taxed at preferential rates. So you see here in D1 that if the marginal tax rate for the taxpayer, other than the dividends, is less than 25% or equal to 25%, then the tax on the dividends is 15%. If the marginal rate on the taxpayer is less than 25%, the dividend rate is 0. So this reflects a rather recent view by Congress that a person earning dividends is indeed not necessarily earning the same type of income as a person who is actually doing work for a wage. This causes a lot of controversy, but one other issue that came up is if a individual pretty much owns his or her own business, then they'll pay tax at the corporate rates for the business itself, and then after they pay tax like that, and after the business just has a tax expense, then if a dividend is paid out to the individual, they're taxed again, and so at dividend rates. And so some people call that double tax, and it's that double tax issue and the idea that dividends are not the same as money earned from actually working in the business, or even interest, that causes them to be taxed a little bit less. So these would be reported on Schedule B if the amount for interest or the amount for dividends is over 1,500. And if you look there at F, that was on the writing, it's just a typo. It says Schedule B for interest the second time. That should have said Schedule B for dividends. Now the point is, you still owe tax on the interest and on the dividends, even if the amount of the dividend or interest is less than 1,500. It's just you don't have to put them on the Schedule B. Here's some other items that are taxed. State and local tax refunds. So the idea is if Virginia gives you a refund, you have to claim the refund the year you get it on your federal income tax return. Unemployment benefits are taxed. Social Security benefits are often taxed now. There's some exclusions from taxation though. Some fringe benefits aren't taxed. Now, don't blow your gasket here. Many fringe benefits are taxed. For example, you've heard that Cadillac healthcare plans. The term Cadillac refers to the fact that a Cadillac is an expensive car. So an expensive luxury type healthcare plan would be taxed extra as a fringe benefit. A lot of times being given company cars is taxed as a taxable fringe benefit, but there still are some non-taxable fringe benefits. And an example might be if a company provides reduced prices for all of its employees for products. For example, if you work at Macy's and you get a 15 or 20% discount, and both you and the company president get the 15% discount, then it's a non-tax fringe benefit. If only the president gets it and you don't, it's usually taxable. Transportation provided by the employer, and it has to be job necessary. So for example, if your occupation was inspecting the subway system in New York City, and so consequently the Metropolitan Transit Authority there gave you a subway pass, the subway pass would not be taxable as a fringe benefit. If you are reimbursed for moving expenses, these are not subject to tax. On the other hand, a lot of times if you're just given a lump sum amount for moving, you'll have to do some reconciliation and see if you got more money or not than you should have for the expenses, because the extra amount could be taxable. Scholarships are typically non-taxable. Gifts and inheritance, for purposes of this tax book, we're saying they're not taxable. Now, I need to point out here that both gifts and inheritances eventually are accumulated and can result in estate tax if they exceed a certain amount of money. And that amount is very high. It's beyond the scope of the class. But keep in mind, while we are looking at gifts and inheritance for our purposes as exclusions, in real life, they are exclusions from regular tax. They're accumulated, and they can wind up being subject to a gift or estate tax later on. Well, that's gross income and the inclusions and exclusions. Let me know if you have any questions.